Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street, delivered right after the closing bell. Please note, this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now, let's dive in. So today, the market just felt like it was in the middle of this almost frantic sector rotation. It set up a really baffling conflict.
It really did.
You have the Dow hitting record highs, while other major indices were just flat or even negative. So I guess the core question for us today is, does this surge signal real optimism, or is it more of a symptom of capital retreating into a survival strategy?
Oh, it's definitely the latter. I don't think there's much question there.
Really? The divergence today was screamingly clear. I mean, you just look at the Dow Jones Industrial Average was the shining light. It jumped nearly 560 points.
Pushing it to a new record close, right near 47,930. That's a 1.18% gain.
Okay, but then you contrast that with the Nasdaq.
Exactly. Contrast that with the tech-heavy Nasdaq, which dipped 0.25%. This isn't broad enthusiasm. This is a highly, highly targeted rotation. Money is just aggressively exiting high valuation growth and moving into defensive, established value names.
And that sort of cautious mood wasn't just in stocks, right? If you look at the cross-asset signals, investors were clearly hedging.
All over the place.
Gold rallied, pushed past $4,100 an ounce. And that seems to be driven by renewed expectations that the Fed's going to cut rates sooner rather than later.
Yep. And at the same time, the dollar was testing critical support, down near 99.35.
So that combination, gold up, dollar softening, that really suggests a defensive posture, but with this aggressive bet on monetary easing.
It's a very specific bet. And if you dissect the S&P 500, which, it barely managed a fractional gain of 0.21%, that story of a survival strategy becomes even clearer.
So what was inside the S&P that tells that story?
Well, 8 of the 11 sectors closed higher, but the leaders were just overwhelmingly defensive. Healthcare led the charge. You had stalwarts like Merck, Amgen, J&J. Those were providing massive fuel for the Dow's record day.
Okay, so healthcare's number one.
Then you had financials. They were strong too. Bank of America and Wells Fargo both notched 52-week highs. And, guess which sector was the only major one firmly in the red?
Has to be tech.
Information technology. Down 0.5%.
Okay, let's unpack that tech sell-off, because this feels less like a simple consolidation and more like a genuine AI valuation reckoning. Just days ago, these AI names were untouchable. They were driving all the rallies. Now they're suddenly being treated like liabilities. What happened? Did the growth thesis just suddenly break?
I don't think the thesis broke. No, it was the execution risk. That's what investors are punishing now.
Execution risk.
Yeah, there were 2 huge negative headlines today that basically confirm that market participants are done rewarding potential. They want proof. First, CoreWeave, the AI cloud provider, it plunged 16%.
16. Why?
They cut their 2025 revenue and their spending forecasts because of developer delays. This is a crucial signal. If the infrastructure providers can't execute their build-out seamlessly, the whole AI supply chain it slows down.
That suggests the margin for error right now is basically zero.
Precisely. And then there's Nvidia, the AI bellwether. It shed 2% today. SoftBank disclosed they sold their entire $5.83 billion stake.
That's a huge institutional exit.
That's institutional money hitting the doors. And you pair that with the lingering effect of last week's comment that there will be no federal bailout for the AI industry.
Right.
And you just see the whole narrative supporting these historically high valuations starting to fray and fraying quickly. The long-term AI story might still be intact, but the price the market is willing to pay for that growth right now has dropped significantly.
So even with the Dow hitting these astronomical heights, you've been flagging for a while that the underlying health of the market is dangerously narrow. You call it the breadth problem. Can you just simplify that for us? What are the key metrics telling you?
Right. The breadth problem just means that only a tiny fraction of stocks are actually participating in the rally. So today, for instance, only 27 stocks hit new 52-week highs.
Okay.
But a staggering 172 made new lows.
Wow. That's a huge ratio.
It's nearly a 6.4 to 1 ratio favoring weakness. So to put it simply, for every 1 stock that's doing well, you have over 6 that are doing poorly. And on top of that, less than 54% of all S&P 500 stocks are even trading above their 50-day moving average.
So if less than half the market is trending up in the short term, that means the overall mood is actually trending down, even if the index itself is being held up by a few of these massive defensive names.
Yes, that's it exactly. And that aligns perfectly with what we saw last week with the narrowest breadth reading in over 2 decades. The Dow's record is essentially disguising a pretty widespread technical deterioration under the surface.
I have to challenge that narrative of widespread fear just for a second, though. We did see FedEx pop today.
True.
A major logistics bellwether, a gauge of the real economy. It jumped 5% on expectations of better profit this quarter. Doesn't that strength in commercial activity provide some kind of counterbalance to this defensive story you're describing?
It's a good point, but I'd say one resilient stock, even an important one like FedEx, it doesn't really invalidate the massive rotation we saw across 8 other sectors.
Huh.
And it definitely doesn't cancel out the clear signal from the credit markets, which we really need to talk about.
Okay.
Because the reason this rotation and the narrow breadth are so concerning is that investors are already flying blind.
Which is a perfect transition into our economic context, this informational vacuum. The U.S. Treasury market was closed today for Veterans Day, which takes away a critical signaling mechanism.
Right.
And that's compounded by the government shutdown, which is now, 40 days long? The longest in U.S. history.
Yeah.
What data are we actually missing? How much uncertainty does this create?
It creates enormous uncertainty, especially for the Fed. They are missing 2 full months of employment data. They're missing the key October CPI inflation report, retail sales, housing starts. It's all frozen.
So the FOMC is heading into its December meeting with what?
With almost nothing. They're forced to make these huge rate decisions based almost entirely on fragmented private sector reports and anecdotes. They just lack the core reliable data.
And that informational gap might be why we saw that huge warning signal from the credit markets last week.
I think so. Let's make this simple. Investment-grade credit spreads, you can think of that as the risk premium, or basically the cost to insure corporate debt. They spiked dramatically. They widened by 60% in 1 week.
60%?
Yeah, going from around 75 basis points to 120.
So an investor who owns corporate bonds now has to pay 60% more to insure against a default than they did just the week before. That sounds like bond investors are finally acknowledging the risks that the equity breadth metrics have been signaling all along.
That is exactly right. Credit investors, who are historically the more cautious, rational group, they are finally pricing in the fragility that the big equity indices have been ignoring.
This flight to safety is also creating some weird paradoxes, especially in housing. We've seen the average 30-year fixed mortgage rate drop to 6.22%. That's its lowest level in over a year.
Right.
But typically, lower rates would stimulate housing demand, and activity is just stagnant. Why hasn't this rate drop helped?
It's what they call the rate lock-in effect. All the homeowners who refinanced a few years ago into those sub-4% mortgages, they are extremely reluctant to sell their home and then take on a new mortgage at over 6%.
You'd be giving up a huge economic advantage.
A massive one. So it's suppressing housing turnover to historic lows. We saw only 2.8% of U.S. homes change hands this year. That is the lowest rate in 30 years. Even if rates drop more, unless they fall below 5%, that inertia probably isn't going to break.
Let's pivot back to cross-asset dynamics, because gold is just benefiting tremendously from all this anxiety.
It really is. That surge past $4,100 is driven by traders just aggressively pricing in a high probability somewhere between 60 and 92% of a December Fed cut.
So the optimism about cuts is tied directly to the weak economic signals we are seeing.
It's an inverse relationship.
Yeah.
You see the University of Michigan Consumer Sentiment Index collapsing to a 3.5-year low of 50.3, and you see gold rally.
Wow.
Weak economy, potential rate cuts, demand for defensive assets, it all connects.
And we're also seeing this extreme divergence in the energy complex. Crude oil continues to trade defensively. It dipped to about $60 a barrel.
$59.95, yeah.
Way down by these bearish forecasts that see prices going down to $52 a barrel in early 2026. But totally detached from crude, you have natural gas just surging. It's up over 40% in the last month alone.
And that nat gas surge is being driven by 2 very specific things. The massive LNG export boom and these extremely cold winter weather forecasts across the central and eastern U.S. So it's a demand story that's totally separate from the global oil trade.
And just a quick look at crypto. Bitcoin seems to have stabilized above that $105,000 mark. It recovered from last week's slip below the very psychological $100,000 level.
Yeah.
But are the bulls really out of the woods?
Not yet. I mean, they recovered, which is positive, but the headwinds are still significant. We saw $1.3 billion in Bitcoin ETF outflows last week. That indicates a sustained institutional retreat.
So what's the key level to watch?
Analysts are really cautioning that $98,000 is the critical bull market invalidation level. That's the line in the sand. If it falls below that, it could signal a much deeper technical correction.
Okay, so turning our attention to the immediate horizon, what are the critical catalysts this week that are going to test this new defensive regime?
Well, we're watching Cisco earnings very closely. They come out on Wednesday. After CoreWeave's disappointing guidance today, Cisco's commentary on network equipment demand. That's going to be essential. It'll help determine if AI infrastructure spending is actually broadening out or if it's still vulnerable.
And later in the week, we have Disney.
Yep, Disney earnings will give us a strong read on consumer health and discretionary spending.
Beyond earnings, what's the biggest risk?
The biggest immediate risk is probably the government shutdown resolution. The Senate passing legislation yesterday means that while the market would welcome the shutdown ending, the release of all that backlog data could hit all at once.
So the October employment report, October CPI, it could all drop in a really concentrated way.
In a non-staggered way, yeah. If that data confirms the deterioration that we've already seen in credit markets and sentiment indicators, we could see some very concentrated event risk and a lot of volatility in the coming days.
So if we pull all of this together, what is the core conflict that you, the listener, should really be focused on? We have a Dow hitting record highs, a 560-point surge, but it's coexisting with disastrously narrow breadth, the punishment of these high-flying AI stocks, and a credit market flashing a massive warning sign.
It's a real paradox.
It seems the market is not pricing in broad economic optimism. It feels like it's pricing a recessionary survival strategy, a flight to quality, a flight to defense. So the question for you, the astute observer, is whether defensive gains in healthcare and financials are strong enough to sustain the entire market if that underlying technical structure in the S&P 500 and the Nasdaq continues to fail. That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.